Hi, this is Mike, and I'm here again with Jeremy Plojik with the Superior Lending. And today we want to talk about mortgage insurance.
Fun.
Right? Yeah. Anytime you talk about insurance, you've seen that commercial where that lady goes to the door and she wants her cousin to talk about insurance and it makes the baby fall asleep. Well, that's kind of where I'm at, right?
Okay.
And mortgage insurance can sometimes be the same way. But this insurance can save you money if you can get it lifted off your current mortgage, if you have it on your current mortgage.
Yeah.
So tell us about mortgage insurance and how our clients can deal with that.
So you bring up a good point. It's like any insurance, right? I mean, you get car insurance to save you money. So if you get in a wreck, that you don't have to shell out money for the whole car. Mortgage insurance does the same thing. And don't get me wrong, right? Geico's making money off that, or Progressive. They make money and you save money. It's kind of the whole thing. So mortgage insurance is the same. It's the same thing. What it allows people to do is to purchase a home without having to have 20% for a down payment. Back in the olden days, you had to have 20% down to buy a home. And that's why it's called the American Dream, because people saved for years to come up with enough money to buy a home. And homes weren't that expensive back then too.
That's right.
It was when a Hershey bar cost a nickel. So somewhere in the 50s, they came up with this idea of mortgage insurance, and it enabled people to buy a home then with less than 20% down. So if you don't make your payments on the home, the bank doesn't lose their money. That's the whole idea behind it. So for whatever that's worth. So if the mortgage insurance is, if you have good credit, right? Mortgage insurance is a factor of about 0.28, which raises your APR then 0.28% from 4 to 4.28%. Which is super cheap if your home's going to appreciate. So for example, I ran some numbers this morning, and on a $500,000 house, mortgage insurance is about $150 a month. That costs you about $1,650 over a year, right? Is all. But that $500,000 home would appreciate $20,000 over a year period. So rather than saving a little bit more for every paycheck to try to save money to have 20% down, which is noble, but it's just not practical. It's just not practical today. It's just not.
Okay. And so that's what we can do with mortgage insurance. That's how mortgage insurance can help you to purchase a home now. Now, what if our clients have that mortgage insurance and they purchased a home even last year?
Yeah.
So what can they do? Can they get that taken off there?
Yeah,
because home values have increased, right?
I saw a statistic from the Division of Real Estate that showed that the home price, average median sales price, had come up 34% from March of 2020 to March of 2022. 34%.
Yeah.
So if you bought a home anytime, maybe last August to before, and you still have mortgage insurance, you want to try to get rid of that.
Yeah. And so how do you get rid of it? What's the best way?
So if you have an FHA loan, it doesn't go away. Right?
They've changed that rule.
They've changed that,
and that's there forever.
And you probably wouldn't want to refinance because your FHA rate probably is like 2%. So you probably want to keep it
lower now than it would be now. So it doesn't make any sense to refinance.
Right. But if you've got a conventional loan, again, I don't think it's smart to refinance, because if you bought a home in the last 2 years, your rate's like 3% or less, where rates right now are almost 5%. You want to keep that loan. So what you want to do is call the person to whom you're making payments. Right? Let's say it's Mr. Cooper. That sounds like a nice guy. We're going to call Mr. Cooper and get someone on the phone and say, what does it take to get rid of my mortgage insurance? They'll look into it. They can tell you on their screen. Maybe it's just, sure, we can do that right now, right? And it's as easy as that. Or if they're not really sure about the value, they'll tell you, hey, we need an appraisal. Or some of the jerky lenders will be like, hey, we need you to pay for a $500 application fee to get rid of this.
Yeah.
And then if you're going to do that, you ought to be pretty certain, right, that you have enough value before I'd spend that kind of money.
And so we can help you with that value to know where you're at today versus when you bought that home, because chances are you've got that much equity in that home that you could get that mortgage insurance off and save yourself 150, 200 bucks a month.
Which is worth a phone call,
Oh
right?
yeah, that's worth the phone call.
As much as it sucks to call those companies and be on hold for 20 minutes and then talk to someone whose native language isn't English.
Yeah.
It's worth $200 a month to do that.
Yeah, and that's true. So we can help you with that. And so I don't know.
I wasn't insinuating that you don't speak English.
No. Yeah. Okay. Yeah. Well, I really don't speak English because I'm from Utah County, and it sounds like I'm from Utah County. So anyway, I don't know what else to say about mortgage insurance other than it can help you, and sometimes it can be a hindrance to you, but it has helped you to purchase that home in the past. It can help you purchase that home now, but if you can get rid of it, get rid of it.
Yeah, and I will say just maybe one last thing is, and maybe I already said this, so I'm sorry if I'm being redundant, but it's cheaper now than it ever has been. If you have good credit, because the housing economy is really strong, mortgage insurance is dirt cheap. So there are alternatives to mortgage insurance like second mortgages and LPMI, lender paid mortgage insurance, but for most people, just getting mortgage insurance and getting rid of it as fast as you can is the cheapest way to go.
That's the way to go. So there's, like we talked about last week, let's get a plan if you're a first-time home buyer, or even if it's a second-time home buyer. We can help you with that plan, and these are some of the loan programs that we can point you to. And so again, this has been Mike with Jeremy, and we'll talk to you hopefully next week.